Many advocates of value investing, including one of the richest investors of all time, Warren Buffett, frequently emphasize that in order to maximize your returns from value stock investments, you have to be able to stay the course as long as you possibly can. You may need to hold them for at least 10 years as long as their fundamentals remain strong. Knowing the difference between long-term and short-term investments is highly important. Before you ever plan on buying a certain stock, it's crucial to identify the qualities of great stocks that you can hold for a long period of time. This video will reveal to you the 6 characteristics of great stocks to buy for long-term investing. Number 6. A company that will continue to thrive in the decades to come. Boring and uncomplicated businesses usually create goods and services that withstand all economic cycles. They remain profitable regardless of time. These are typically solid long-term investments. Consumer goods like food, clothing, and electronics are all examples of such products. Whether there is a recession or not, people will need to keep on buying their products as they are all considered essential in our daily lives. Companies like McDonald's, Procter & Gamble, and Clorox are good examples of this. Although there is nothing exciting about them, their products and services will always be in demand forever. Technology companies would not usually fit this criterion, unless they are firmly established and their products are ingrained in our daily transactions. Microsoft and Google are good examples of these companies. Number 5. Strong financial standing. Businesses with little debt and strong cash flow are more likely to endure a downturn in the economy. These businesses are usually stable and with decent or high profit margin and operating cash flow. Sometimes they would pay dividends consistently or do share buybacks. Dividend payments and share repurchases are their means to return profit to their shareholders. Companies like Apple, Google, Facebook, and Microsoft are some of the biggest companies with the best financials in the world. Number 4. Good margin of safety. Before placing an order to buy a stock, you must compare its valuation against its intrinsic value. At the time of your purchase, determine if the stock falls under its fair value compared to its peers in the same industry or its historical financial metrics. Does it always trade around the same multiple? Amazon has always traded in high multiples, but it remains to be one of the strongest companies with the widest moat. There are a lot of metrics to use when calculating the intrinsic value of a business. You can use price to earnings, price to sales, or price to book ratio. You can easily access this information on the internet in the company's investors' relation page or financial websites like Morningstar and Yahoo Finance. Number 3. Steadily increasing earnings. Can a certain economic cycle, like a pandemic, affect the earning power of a business? When there is a miss or decline in earnings in the past, do you know what the reason is? Is it temporary or will it become more permanent? Has there been an increase in profits during the last 5 to 10 years? Is it sustainable to expect them to keep rising? Value investors propose that the value of a stock will eventually follow its earnings in the end. As a company consistently generates higher profits, it is only reasonable that it will go up in value over time. If the earnings are consistently high, the company will even grow further by investing in its research and development, making acquisitions of smaller companies, or returning more value to its shareholders by dividends and share buybacks. Number 2. Reliable and effective management. Do the leaders of a company know what their consumers need and want, and are they able to deliver them efficiently? Are they able to allocate the company's resources properly and use it for the continuous growth of its business? Are they transparent in terms of the financial statements and outlook of the business? Do they return any value to its shareholders? How are they treating their employees in terms of safety and benefits? The future of any company will rely on the greatness of its leaders. The CEO of Microsoft and Google are some of the best leaders for turning their companies into the giants that they are today. Not to mention the iconic Elon Musk, who turned his vision of helping humanity by creating electric cars and launching satellites in the outer space. Before we get to number 1, don't forget to hit the like button if you are getting any value from this video. With that said, here is number 1. Consider the risks. Recognize what could possibly jeopardize your company's stability. Is it a better competition? Is there any disruptive technology? Is it a sizable debt? Is it bad leadership or any shift in the core fundamentals of the business? As a shareholder of a company, you may be prone to confirmation bias, but you should not only focus on the positive side of the business. Assume the role of the devil's advocate and imagine a doomsday scenario. What are the chances of such event actually happening? It's crucial to factor in the downside to be able to arrive at a more realistic upside. Consider the risks to properly evaluate the value of your investments. For more life-changing videos like this one, make sure to watch the next one, as you will definitely find a ton of value from it. Thanks, and see you again.